Hello and welcome to the Money and Banking Law Podcast with Joe Sylvia, brought to you by Duane Morris, an international law firm with roughly 30 offices and 1,000 lawyers all over the world. I'm your host, Joe Sylvia. I'm a former Federal Reserve lawyer who represents banks, fintechs, and financial services clients on M&A, payments, and regulatory matters at Duane Morris. I'm also a core member of our banking, fintech, and digital assets and blockchain practices. Now, while we can't provide legal, financial, investment, or tax advice on the podcast, our goal for the Money and Banking Law Podcast is to inform and educate our clients and friends on both the fundamental concepts and structure of the banking ecosystem, as well as critical developments in the law and regulation of money and banking. Thanks for joining us today. As always, if you have any questions from any of our podcast episodes, please reach out to me at jsylvia@duanemorris.com. On today's episode, we're talking about strategic priorities for banks in 2026. I recently scanned through the Illinois Bankers magazine that I get every month and found an interesting article talking about the spending outlook for 2026 and the bankers' top 5 strategic priorities for 2026. Now, obviously, this is not a survey that I conducted, but rather was a survey that a software provider, CSI, had conducted and wrote this short article about. I thought it was interesting, so wanted to review it today and see if there were any thoughts about where you think your institution may be going in 2026 with its strategic priorities for spending issues. The number 5 priority is customer support improvements. So customers using both the physical and digital channels, and banks looking for additional support in those areas. So expecting to spend some amount as a strategic priority in these areas of customer support. So spending in this area, according to the survey, would be investments in better digital self-service for status updates, disputes, and card controls, contact center tools that reduce repeat calls and increase resolution speed, so in tech that enables more streamlined and efficient customer support, and then smoother account opening and onboarding to prevent attrition. So this is another thing. I've been doing a lot of work with my institutions on third parties that are providing technology support in these and some of the other areas that we'll talk about today. So I absolutely can provide tangible evidence that banks and traditional financial institutions are actually looking at this area as a strategic priority, looking at the technology offerings that we'll talk about in the next few minutes as strategic priorities for them and their institutions, primarily for customer acquisition, operational efficiency, and so forth. Number 4 is market expansion. So constant goal for financial institutions, whether it's within market or outside market, to acquire customers in new markets, members in new markets, and so forth. They say in the article that it seems to be that there's a focus shifting from quantity of market expansion opportunities to the quality. So really strengthening the quality of the relationships that banks and credit unions have with their customers and members, as opposed to just willy-nilly going out and expanding the market. They're expanding the market more intentionally, it seems. So the article indicates that strengthening primary relationships, so account holders are more likely to deposit funds, use debit cards, and adopt additional services, is where the focus is leading. So what does that mean for focused growth? They say, well, 92% of the bankers that they surveyed agree that the institution should be growing their existing customer base, or is growing their existing customer base. 82 said they want to increase retail deposits, and 86 said generally they want to increase the commercial aspects of their business. Okay, so especially for banks, they're focusing on commercial lending, commercial products and services, treasury, cash management services, and so forth. Spending for this kind of market expansion, the survey talks about, includes smarter deposit acquisition through tighter targeting, more strategic offers, fast, seamless onboarding to drive more usage, and then debit card swipes, including debit card swipes. Secondarily, retention and primary focus through direct deposit capture, better day-to-day value, and fewer reasons to leave. And then finally, on the commercial relationship growth side, they want to win more of a business's everyday banking, not just the initial loan, not just that loan relationship, but rather, like I mentioned earlier, the loan, the deposits, or some deposits, potentially treasury management, cash management, potentially other areas of support that each individual institution may be able to provide for a commercial customer. Number 3 in this survey was operational efficiency. I mentioned that before. At the center of modern deposit analysis, the survey indicates, or the article indicates, is decay. So that's the rate at which balances naturally run off over time. Decay rates measure the rate at which deposit balances diminish over time, and so it's like prepayments on the loan side. The article importantly indicates that by pairing decay rates with weighted average life and effective duration, banks gain a clearer picture of how reliable their funding really is under changing market conditions. This distinction becomes especially important when separating core balances from surge balances, which are just the funds that are more likely to leave when rates or conditions change. So they're not really considered those core deposits that both the banks and the regulators really put a focus on and really like to see more so than anything else. With respect to surge balances, the article says failing to identify surge behavior can leave institutions exposed, particularly if temporary liquidity is mistakenly treated as long-term funding. Definitely the case. Have spoken with a couple of clients specifically about long-term funding goals and objectives, strategic matters related thereto, and what potential service and service provider offerings might be there to, again, create some operational efficiencies in this area. Number 2 and number 1 are, or should be, no surprise to anyone. Number 2 is cybersecurity, fraud, and defense. The cost, as this article indicates, the cost of being unprepared for a cybersecurity incident or a fraud incident with respect to monetary losses of account holder, customer trust, reputational losses, is continuing to increase and is much higher than it used to be, as the article indicates. It says AI is part of the problem and part of the solution, but fraud and financial crimes are just as concerning. In the CSI study that's outlined with this article, card and check fraud remain the most common types of fraud, but close behind are phishing, wire transfer fraud, P2P fraud, and fraudulent account opening. We see a lot of questions coming in related to fraudulent account opening and unauthorized transfers. So spending in the cybersecurity and fraud defense area is absolutely critical for banks, not only 2026, but going into 2027. I know it's a little early to talk about 2027, but it is July, towards the end of July almost now. So these are really, really important aspects of spending for banks and other kinds of financial institutions, whether it's credit unions, fintechs, digital asset companies, or otherwise. Cybersecurity, fraud defense is absolutely critical for a lot of reasons, including the ones that are outlined here in this article. For the cybersecurity and fraud prevention spending, there's a number of different areas where the banks seem to be spending money according to the survey. So they say stronger login and identity verification controls, dual authentication measures, and so forth, trying to prevent phishing, trying to prevent account takeovers, prevent those unauthorized transfers that create so much havoc. Improve fraud detection and response, so trying to identify fraudulent or potentially fraudulent suspicious activity earlier and with more velocity. Payments, with respect to payments, putting on tighter payment safeguards, things for checks, wires, and other payment channels, trying to make sure that to the extent that we can avoid fraud in the payment realm, in the payment rail sector, that we're doing everything we can to do that. Next, practical scam awareness training. Again, this is, as a lawyer, you do this, as a banker, you do this. You have so many different trainings you have to go through. My brother-in-law is a consultant. He does M&A tax, and he does a ton of training on this and a myriad of other issues, but making sure that we have the adequate, appropriate, and updated cybersecurity training, data breach notification training, and so forth, not only from the service provider's perspective with outside legal, outside consultants, and so forth, but really internally, because those internal folks, the C-suite, especially the financial functions, technology functions, those are the ones that are most at risk for cybersecurity attacks, for phishing attacks, and so forth. So to the extent that we can increase awareness and increase through training, but then also increase the success with the training, that really helps deal with real-world, real-time fraudulent issues. Finally, they talk about fraud and cybersecurity spending in the space of resilience planning. So system isolation, data backup, recovery testing, incident response rehearsals. These are things that are really frustrating to have to deal with, but wildly important when it comes to the spend. Finally, we talk about technology modernization. The foundation of everything else depends on. That's what we hear here right now. So technology modernization, number one on the strategic priorities list. I think this can probably encompass almost everything that we've already talked about here. It's a wide range of projects, as the CSI study indicates. We improve how systems connect, how data flows, how new capabilities are delivered across the organization. The need becomes even more apparent in commercial banking. Technology limits or integration gaps are cited as the top barrier to expanding commercial portfolios. The OCC is also warned that quote-unquote, a lack of investment in new technologies, products, and services may present material risks to long-term bank performance and viability of institutions. This modernization spending likely going to target cleaner integration and data consistency, simpler vendor environment, and easy to govern foundations, right? This is so security, analytics, and fraud controls can scale more easily. I highly recommend you take a look at not only the article that's in the Illinois Banker, excuse me. If you want a copy of it, just shoot me a note. I'm happy to send a copy out. Take a look at your spending priorities. Take a look at what you're expecting for the year 2026. And then also take a look at the 2026 CSI Banking Priorities Report. It can be found at www.csIweb.com/docs/banking-priorities-2026. Again, if you have any questions, please feel free to reach out to me, but I do encourage everyone to really take a look at their technology spend, really think critically about what the expectations are for the rest of this year, and then 2027 in terms of your vendors, in terms of fintech, in terms of the use of technology going forward, going to be wildly important. I would definitely take a look at the report. Let's chat. Let's talk about priorities. Let's see if there's some ways that I can be helpful in working with you or working with your clients, friends, associates, whoever, both on and off the clock. Wildly important. More and more issues are popping up with technology vendors and access to information. So feel free to reach out at any time. Otherwise, that's it for today. Quick episode coming out to you from the peninsula up north. You know where to get me, jsylvia@dwaynemorris.com if you have any questions. Otherwise, be sure to like and subscribe wherever you get your podcasts, and I look forward to speaking with you soon. Thanks. Take care.